All right.
Presentation is still here.
Okay. Hello, everybody, and welcome to our webinar on sustainable private finance under the European Green Deal. It's 10 o'clock, so we can start with the presentation. First, we'll start with basic description what sustainable finance is. Among the scholars and among the regulations currently applicable, there's a consensus that this is actually a process of taking into account of environmental, social, and governance considerations, ESG, in business and investment decision making, which leads to increased investments into long-term and sustainable activities. Basically, what governance consideration itself represents: governance, management structures, relations, and executive remuneration. Environmental includes all the possible environmental aspects, the impact on current environment, mitigation of possible negative effects on the environment, the sustainability of ecosystems, circular economy, and so on. What are the key considerations in sustainable finance? Basically, the definition itself takes certain key points which receive special attention. Within the scope of environmental, we have the climate change mitigation and adaptation and the general impact on the environment broadly. So biodiversity preservation, pollution prevention, circular economy, and so on, and the actual risks which arise from possible deterioration of environment or possible negative effects on the environment, such as natural disasters and so on. The social aspects are also the broader aspects of inequality, inclusiveness, labor relations, HR matters. And the governance as such is also the actual taking into account the environmental aspects as well as social aspects into their governance, into their decision-making process, and into their, let's say, day-to-day operations. The research has found in the recent years that the key drivers for sustainable finance activities, so for taking sustainability into account when making decisions in financing a certain business or certain operations, are mostly coming from the pressure of either consumers or the investors themselves. The evidence shows that the investors do not only want to have a sound investment financially, but they also want to have certain assurance that the investment is also ethical. So it does take into consideration certain sustainable goals, such as already mentioned, environmental, social, and governance goals. Same comes from the perspective of the consumers. The awareness of positive sustainable goals or general sustainability has significantly risen in the past years, and also the expectation of consumers are that the companies or the providers of goods and services do have high standards in this respect. So these are the background drivers in this respect. There has also been some evidence and some researches which do show that there is a correlation between a company's strong credentials in relation to sustainability and its strong financial performance. So empirical evidence show that company which takes due care of sustainable activities and puts strong emphasis on this is more likely to be also financially successful. And finally, as already mentioned, the reputational risks are getting more and more into account. They're more and more magnified. So the risk stemming from possible loss of reputation, not taking into account certain sustainable aspects, can have a substantially or significantly negative effect on a business of a certain company. We have listed here on this slide certain typical sustainable finance activities from the side of private investors or private financiers. One is the creation of funds, which deal exclusively with sustainable businesses. The other one is green bonds which have as their use of proceeds green or sustainable activities. Impact investing, which would be the target investment into a certain environmentally effective solution, which brings a significant positive impact on the environment and as well brings certain financial benefits. Microfinance, this would be SMEs, small businesses, loans or credits for sustainable projects, and generally the rules and regulation which positively contribute to the whole financial system in a more sustainable way, taking into account of sustainability goals.
So we have a question: when did sustainable finance came into the spotlight, and what political acts brought the sustainable finance into the spotlight? Maybe it's not the beginning, but it's actually the culmination of a long process. Was the UN Sustainable Development Goals resolution, which was enacted in 2015 by United Nations. All countries which are member states of United Nations, 193rd of them, signed this resolution in 2015 as a universal call for action to make development more balanced within this SE social, economic, environmental factors. So development should be balanced. It should include all developing countries and already developed countries. And the United Nations Sustainable Development Goals brought into spotlight 17 integrated sustainable development goals, which are somehow a blueprint how to achieve a better and more sustainable future for all. So it's all inclusive. These goals are in a way bright, interconnected, and they could be differentiated into 3 layers, like a wedding cake in a way. So at the bottom, we have to take care of our environment. So we have a goal of climate action on preservance of life below water. We want to have clean water and so on. So as a basic layer, we have to take care of our climate, our biosphere. As the middle layer, we have to take care of our society. Why we want to have society where people are not hungry, there is no poverty, people get chance for good education and good health, there is equality between genders and so on. And on the top of this is the economy, which also should take care for all other goals as much as it can, and has to be also inclusive, that growth is sustainable, industry becomes more circular and sustainable. And on top of the cake, as a cherry on the top, should be partnership for all these goals, because one country cannot tackle all these issues alone. The whole world will have to work together to achieve them. The action is set for these goals to be achieved by 2030, which is very optimistically, but the countries are acting in this direction, and each country has room for its own actions. And also Slovenia adopted its Sustainable Development Plan in 2017. These are the goals that brought spotlight to sustainability and inclusive development for all. 1 year later, the Paris Agreement was adopted, which is trying to achieve the the prevention of increase of global temperatures. And as a response to the Paris Agreement, the new Commission enacted or start with this European Green Deal at the end of last year, 2019, as a global response to the climate change threat, for sure. And the new Commission set a very, very ambitious plan to change European Union into first climate neutral bloc by 2050. Climate neutrality means that there is zero balance of carbon gas emissions. So you are trying to prevent the emissions as much as possible and to offset the remaining emissions that there remains. And it's a broad agenda which comprises basically every segment of our economy and includes policy areas such as biodiversity, sustainable food systems, sustainable agriculture, clean energy, sustainable industry, building renovation and sustainable mobility, eliminating pollution, and also climate action. And the ambition of European Commission is to go through all regulation, to see what works toward this goal of achieving climate neutrality by 2050 and what doesn't work, and amend, change, and do whatever is necessary from regulation point and political point of view to steer European Union towards more climate neutrality. And how this will be done? Of course, if you want to transform the economy from now to this future carbon neutral economy, we need financing. And European Commission said European Green Deal investment plan. This is the investment pillar of Green Deal, which should mobilize at least 1 trillion euros in sustainable investment over the next decade. The funding will not come only from the European Commission and from public funds. It is necessary to mobilize private investors as well. The private investor will probably be the key to financing green transition, and European Commission is working towards helping private investor to identify projects which should be financed, to help them construct financing, and in various funds from national to European funds will help the participants by providing them with tailored financing to really wide range of projects, from very big to very small scale projects, in order to make the turn to change the tide and to become more sustainable and climate neutral by 2050. So, sustainable goals and climate neutrality. What's the action plan on financing sustainable growth, Klemen?
So, for the attendees who joined a bit later, I just wanted to mention that we'll be answering the questions at the end of the session. That will be after 10, between 10 and 10:30, and you can post your questions in the chat section in the lower right corner of this interface. So we can discuss this at the end of the session. So when you come to the action plan, the European Commission launched an action plan or initiated an action plan in 2018 on the financing of sustainable growth. So the action plan is sort of a 10-step plan which aims to first reorient capital flows towards the sustainable investments to achieve a certain sustainable inclusive growth. Secondly, to put the sustainable aspects into risk management as one of the mainstream aspects, because so far they have been put a bit too much aside. And thirdly, to foster more transparency, more openness in this respect, and long-termism, meaning that the investment itself would be more long-term oriented as compared to the current status. So when we come to the action plan, we can go action by action. First action is the unified classification system for sustainable activities. What this basically is the new taxonomy regulation. It's sort of a dictionary or a glossary what a sustainable activity is. It contains the entire definition and the entire factors, segments of sustainable activity, which allows for all the participants, including investors as well as the investees, to rely on certain definition of what a sustainable activity is when making investment decisions. We'll come to this in more detail later. Action number 2 was creating standards and labels for green financial products. Most notably, this is the new, currently still draft EU green bond standard, providing for standards which need to be fulfilled by a bond or another debt market financial instrument to be able to be called the EU green bond. Action 3 is fostering investment in sustainable projects. This one mostly relates to the European Union's funds, and they're coming from their own budget and their own funds. Action 4 is incorporation of sustainability in financial or investment advice. This means that all the regulations which regulate financial investment advice, including the directive on financial instruments, the alternative investment fund managers, the solvency directive regulating the insurance companies, they all will be amended to take due account of sustainability when making decisions on that basis. Next action is developing of sustainability benchmarks. So this is the amendment of the benchmark regulation. This will bring a new category of benchmarks comprising of low carbon and positive carbon impact benchmarks, which should or will prevent investors with better information on the carbon footprint of their investments. Another action is relates to the ratings and market research. The guidelines on disclosure requirements for credit ratings updated, which basically means that the credit ratings will take more detailed, more oriented approach also to the sustainability measures, sustainability as such. Not that they didn't take it into account already before, but they might not have been primary focus, or they have been actually taken into account only as a secondary measure when making the whole assessment. Action 7 is the institutional investors and asset managers' sustainability duties. These are the necessary and required disclosures in the disclosure regulations, which will also need to take due account of sustainability goals. The next action is the prudential requirements. This is again also still ongoing. Basically means that the directives regulations applying to banks, credit institutions will eventually have amendments which will incorporate in the risk assessments and requirements for banks, also in their prudential requirements, also an exact incorporation of sustainability and clear regulations in this respect. The European Banking Authority already published its action plan on sustainable finance, which explains its phased approach, advises and guidelines, and certain technical standards which were mandated to European Banking Authority to be implemented in this respect. Action number 9 refers to the non-financial disclosures directive and international financial reporting standards. So also here, the sustainability disclosure is being more put up front into this assessment and into this rulemaking. So it's really being taken into account when making such assessments. And finally, action number 10, fostering sustainable corporate governance and attenuating short-termism in capital markets. The basic idea was that, first of all, the European supervisory authorities were requested to make reports on short-term pressure of the financial sector on corporations. The reports were published about a year ago, and the result was the recommendation to strengthen disclosure of sustainability factors, which would facilitate institutional investor engagement. And at the core of the regulation is the EU Taxonomy regulation, as already mentioned. And I switch the word to Neja.
Yeah, I would just add that the most important action plans within this action plan are taxonomy regulation, disclosure regulation, benchmark regulation, and EU green bond standard, right? And we will talk more about these 4 pieces of current legislation in the next hour. So what is EU taxonomy? As Klemen already mentioned, it's a kind of dictionary that determines uniform criteria for what economic activities can be considered as environmentally sustainable. We were talking about sustainable goals at the beginning of this session, and we mentioned our environmental, social, and governance factors as being very important to this definition. I would like to point out that taxonomy regulation for now only determines criteria with regard to environmental factors. It doesn't determine criteria with regard to social factors, but it intends to do that in the next steps. So for now, we are only talking, we have a uniform language for environmentally sustainable activities. The aim of taxonomy is for sure to increase transparency, to have a common language, to limit the risk of greenwashing so that not everything can be labeled as green and sustainable if it's actually not. And it's also important to have a common language within the whole European Union in order to prevent the risk of market fragmentation. The taxonomy should enable scaling up of sustainable investment. It is helping private investors to determine what projects are sustainable and what not, and to work on those. It does not mandate any investment into environmentally sustainable economic activity, which means it doesn't force or mandate anyone to invest in these activities. It just tells when an activity can be considered as environmentally sustainable. Klemen, I hand back to you, who's affected by taxonomy.
So the taxonomy regulation comprises, in essence, of 4 tests which an economic activity must fulfill to be considered as environmentally sustainable. These are the following. First of all, the taxonomy regulation sets certain environmental objectives, and an activity must contribute substantially to at least one of those objectives. Secondly, it must not do any significant harm to any other environmental objectives to which it does not contribute substantially. Thirdly, it must be carried with certain minimum social and governance safeguards, standards. And finally, it must comply with the technical screening criteria, which is to be adopted under regulation. If we go to the first point, the environmental objectives, the taxonomy regulation takes due account of climate change mitigation, pollution prevention, protection of ecosystems, climate change adaptations, transition to a circular economy, and sustainable use of water and marine resources. In essence, climate change mitigation relates to the process of holding the increase of global average temperature to well below 2 degrees centigrade as compared to the pre-industrial level, with the aim to try to keep it or to limit it to 1.5 degrees centigrade. This is as laid down in the Paris Agreement. The climate change adaptation means or relates to the process of adjustment to actual and expected climate change and its impacts. Circular economy, as we already said, it's an economic system where the resources are being reused for and maintained for as long as possible, enhancing their efficient use in production and consumption, and protection of ecosystems, pretty much dynamic complexes of plants, animal, and microorganism communities, which needs to be protected as a functional unit. Finally, sustainable use of water and marine resources. It's pretty clear that we need to be sustainable project or whatever is being the goal is to keep the water and marine resources in a sustainable use. The second point was do no significant harm. So what the taxonomy regulation says is if you were to contribute substantially or significantly to one of the goals, you at the same time are not allowed to do any harm to any of the other sustainable goals, which means, for example, if you do significant harm to a climate change mitigation, means that your activity would lead to significant greenhouse gas emissions, for example. Or if you do significant harm to sustainable use and protection of water and marine resources, means that you do any actions which are detrimental to that, so the use itself is not sustainable. Similarly, if you do harm to circular economy, means that you create substantial amounts of waste. You do not abide by this rule of recirculation, reuse, and so on. So what's important here is that for the price of pursuing a certain sustainability or environmental goal should not be harm, or at least significant harm to any of the other goals. Third point is the compliance with minimum safeguards. What's important here is there are certain multinational, international guidelines, the UN guiding principles on business and human rights, the principles and conventions on rights at work and human rights. What basically is meant here is there are certain minimum social, environmental governance guidelines, let's say, which need to be observed. Certain minimums set out by these documents, which are, let's say, a basis for such an activity to also qualify being environmentally sustainable. So this is basically the bottom line, or let's say the broadest principles from these fields, which are necessary to be observed. Many of them are incorporated by reference into the taxonomy regulation. The last point is the technical screening criteria, and I give the word back to Neja in this respect.
Yeah, these technical screening criteria are to be adopted by European Commission as delegated regulation. It is currently under discussion, but these criteria need to specify really the flash, what activity makes the substantial contribution to a given environmental objective and at the same time does not harm significantly other objectives. So here you have to go into details, and currently here is where all the political fights will be fought for, because here this document will determine what activity is environmentally sustainable and which activity is not. So the timeline for adoption of these technical screening criteria is quite tight. Criteria for the first two environmental objectives, climate change adaptation and mitigation, should be adopted by the end of this year, and taxonomy will apply from 1st of January 2022. And the The technical screening criteria for the remaining 4 environmental objectives are to be adopted by the end of next year, to apply from the 1st of January 2023. So I mentioned before that currently a delegated regulation, which is containing the technical screening criteria for the first 2 environmental objectives, climate change mitigation and adaptation, was published for discussion in mid-November, and it's open for discussion until 18 December. It is still expected that this delegated regulation will be adopted by the end of this year, but the European Parliament and Council have then 4 to 6 months to raise objections. As mentioned, it's a lot of stake, especially for energy, transport sectors, and there's a lot of fight going on in determining what is sustainable and what is not, because the funding will depend on this technical screening criteria and so on. And just for you to better picture how big this document is, this delegated regulation has more than 500 pages, and it's Annex 1, which is determining which activities qualify as contributing significantly to climate change mitigation while not harming any other objective, has 230 pages. It's determining very precisely how an activity can qualify as environmentally sustainable, and there are definitions and prescriptions for each of other environmental objectives, how an activity should be performed or should be done in order not to harm the other objective. So there's a lot of flesh here, and it's, as one lawyer said, it's not for light-hearted persons to read into these details. And I would just like to mention that this is a political act at the end of the day, because there are huge discussions about nuclear energy currently going on. Nuclear energy, it's not included as environmentally sustainable right now in this delegated regulation, but the European Commission said that it is still under review. So there are pros and cons to include nuclear energy also as environmentally sustainable, because it's contributing to climate neutrality, but at the same time can be producing a lot of very damaging substances. So the fight for what should be included into taxonomy regulation and whatnot, into this technical screening criteria or whatnot, it's far from over. And the next piece of legislation is disclosure regulation. Now we've been talking about taxonomy and environmentally sustainable activities. Here, disclosure regulation has, again, all 3 objectives, environmental, social, governance objectives, included in their definition of sustainable investment. This disclosure regulation was adopted earlier than taxonomy regulation. It was adopted at the end of last year, 2019, and will apply from the 10th March 2021, next year. So basically we have less than 3 months to prepare for disclosure regulation. While taxonomy regulation applies for member state countries and various participants, it's a very broad scope of application. Disclosure regulation only applies for financial market participants and financial advisors. So we have only 2 groups of market players for whom this regulation applies. It's still under discussion whether this should be applied more broadly, but for now this is what we have. As said, again, here we have all ESG objectives included in the definition of sustainable investment. It's something that contributes to environmental objectives at the same time, or to social objectives. It doesn't do any significant harm to other objectives, and the company which is making this investment follows good governance practices. Disclosure regulation, as said, applies only for financial market participants and for financial advisors. The financial market participants which are covered are basically investment firms or credit institutions which provide portfolio management for their clients. It applies for various producers of pension products. It applies to fund managers, alternative investment fund managers, or UCITS managers, and it applies for managers of qualifying venture capital fund, qualifying social entrepreneurship fund, and also for insurance undertaking, or which makes available insurance-based investment products. Which is, And the financial advisors that are covered are, again, insurance undertakings or insurance intermediaries, which provide advice with regard to these insurance-based investment products. It applies to investment firms or credit institutions which provide investment advice. And as well, it applies for alternative investment fund managers and UCITS fund management company, which provides investment advice in accordance with its sectorial regulation. So these are the persons covered by disclosure regulation. The disclosure which has to be made relates to three key areas. The first is integration of sustainability risk in their investment decision making. So the companies will have to disclose how they integrate the sustainability risk in their investment decision making. Here it is important to know what are sustainability risks. Klemen already mentioned that. Those are risks that come from some unsustainable practice. It could be risk of flooding due to climate change. It could be risk of general strike due to some social, due to labor relationship and so on. And the question here is, how are these sustainable risks integrated in the investment decision making of financial market participants and financial advisors? The second one is what's the adverse impact of the firm's investment decision or advice on sustainability factors. Again, sustainability factors are environment, society, governance. So does the company take this adverse impact into consideration at all, or does it not take it into consideration? And the third part is with regard to the financial products which the company sell or advise on. There will need to be some provision of sustainability related information for those financial products that has their environmental or social characteristic or have sustainable investment as their objectives. As said, this disclosure regulation will apply from the 10th March next year. So the timing is quite short for the companies who haven't started preparing for this disclosure. There are three categories of financial products which are covered under disclosure regulation. First are the financial products which have sustainable investment as their objective. They are promoting sustainability. This is also part of their marketing. The second are those financial products which promote, amongst other characteristics, environmental or social characteristics of the investment. Again, you are promoting that you are green, sustainable, and the rest of the financial products. And for the first two, there will be additional disclosure which will have to be made at the product level. For the rest of them, disclosure is less demanding. Disclosure regulation determines 4 types of disclosure which will have to be made by these market players. First is website disclosure. Second are pre-contractual disclosures. Then there is periodic reporting and consistent marketing communication. wherever you disclose the information have to be clear, succinct, understandable to investors. They have to be published so that it is easy to find them. They have to be accurate, fair, updated, not misleading, simple and concise. And again, here we will need more detailed advice on how to present this information, and the ESAs, these are European authorities, European Banking Authority, European Securities Markets Authority, and EIOPA, prepared their level 2 regulation on how to present this information. The European Commission should, I think that this regulation should also be implemented by the end of this year and will apply from the 10th March next year already. So it's a very demanding, these are in a way demanding time for fund management companies and for banks who manage portfolios and for insurance companies, because they will have to disclose many information by March, and currently the actual how this will have to be made, it's not clearly defined yet. It's expected that it should be defined by the end of this year or maybe in January next year. So there will be only 1-2 months left before these rules will have to be applied in practice as well. And last but not least, about this disclosure regulation, taxonomy regulation actually is amending another regulation, that's another directive, that's non-financial reporting directive, in a way that it forces the companies of public interest with more than 500 employees for whom this directive applies to include certain additional information in their non-financial information statements on how and to what extent their activities are associated with environmentally sustainable economic activities. Again, this is additional obligation where it is not clear now what does it mean to be associated with environmentally sustainable economic activity. So here, European Commission will also have to provide additional rules and standards and guidelines. How is this associated with to be interpreted and so on? But direction of European Commission is to force additional disclosure, not just for the financial market players, but also from other companies, for now only from the companies for whom this non-financial information directive applies. But it can be expected that these requirements will, over the next years, be pushed to other types of companies as well. For now, what these public companies which have to disclose information under non-financial, under NFRD, have to disclose in accordance with taxonomy regulation is that they have to disclose proportion of their turnover which is derived from products or services which are associated with environmentally sustainable economic activities, and the proportion of their capital and operating expenditure related to assets or processes associated with such activities. There is a lot of pressure on these companies currently because what is lacking still a bit on the market is what is really associated with environmentally sustainable and economic activity and how to quantify them. And all these developments are going on in the market. Within the European Commission, there are many discussions within all various types of market players and regulators. And we will see over the next few years how this will and in what direction this will be stirred. As the third pillar of this action plan on sustainable finance, there's a benchmark regulation. If you want to promote investment in sustainable finance into a certain direction, then you have to have certain benchmarks. So 2 additional benchmarks were added to our benchmark regulation. This is EU Climate Transition Benchmark and EU Paris Aligned Benchmark. The Climate Transition Benchmark is maybe a little less regulated, or the goals which have to be achieved by the assets underlying this benchmark is a bit lower than the EU Paris Aligned Benchmark. So the EU Climate Transition Benchmark have to have the underlying assets, which is on a decarbonization trajectory. This means actually a measurable, science-based and time-bound trajectory towards alignment with the objective of Paris Agreement by reducing various types of emissions over the course of time. And it's constructed in accordance with the minimum standards laid out in delegated acts. These minimum standards determine how much, in a percentage way, greenhouse emissions should be lowered. And the EU Paris Aligned Benchmark requires that underlying asset is selected in such way that portfolio's carbon emissions are aligned with the objectives of the Paris Agreement, which is the lowering of global temperature. Again, it's also constructed in accordance with the minimum standards and should do no significant harm. The activities related to the underlying assets should do no significant harm to other objectives. And just additionally, what these minimum standards are, so that we can picture this better, maybe is that the greenhouse gas intensity or absolute emissions must be at least 30% lower for the first benchmark, for the transition benchmark, and at least 50% lower for the Paris benchmark than the emission of the investable universe. So if you have a comparable universe, comparable investments, these assets that are included into the benchmark should produce at least 30% lower gas greenhouse emissions than the rest of the investments. And yearly decarbonization trajectory is 7% reduction, which, according to the market research, is quite high. So it will be interesting to see how this trajectory will be fulfilled by market players. And additionally, the final pillar of this investment actions are EU green bonds EU green bond standard, and Klemen will tell us more about that.
So the European Commission has delegated to a group of technical experts comprising of legal academia, government officials, professors, as well as practitioners, to come up with a certain green bond standard which would work at the EU level, and if a bond or a financial instrument would fulfill the requirement of such standards, it would have the right to use the title of an EU green bond. But before coming to the standard, maybe just a bit of a basic background on the green bonds. Politically, these are the bonds which are designated or intended to encourage sustainability, to support climate-related or other types of special environmental projects. So far, the green bonds market is developing, but it's still its growth is still limited. Current share is below 1% of the total bond market. This is also due to the fact that there are certain prevailing barriers to the green bond market. First of all, there's a lack of green projects which could qualify for these green bonds. There are certain issues, concerns with reputational risks and green definitions. Prevailing clear absence, or at least I should put more clear identification of the economic benefits for the issuer. The procedure as such is complex, costly. There's a lot of reporting requirements which would need to be fulfilled, which require a lot of workforce. And there's also certain uncertainty on the type of assets and expenses which could be financed within this framework. The goal of the European Green Bond Standard is to try to reduce or to lessen these barriers to green bond market by setting clear set of rules for a green bond. So far, the most commonly used protocol for the green bonds which have already been issued has been the International Capital Market Association's Green Bond Principles. Now, as mentioned, the technical expert group, as nominated by the European Commission, drafted a proposal of a green bond standard. And the first question which immediately arose is whether this standard should be voluntary or whether it should be mandatory. Current proposal proposes that the standard is a voluntary, a non-legislative piece of document. However, discussions are ongoing, and within the European Commission, as well as within the various stakeholders, there are certain suggestions which would go more in the direction of making this also a binding or a legislative standard. But as mentioned, the discussion phase is currently ongoing. Actually, as we speak, I believe the deadline for the final comments on the proposal ends sometimes in this December. What's clearly presented as the costs and benefits of the issuers themselves. Obviously, the enhanced reputation by having issued a debt capital instrument which contributes to sustainability, environment, and so on. There's also an improved and more standardized reporting in this respect given to investors. However, as already mentioned, the drawback is extra work, more reporting requirements, which could be burdensome for certain issues. On the other hand, the investors themselves will get good quality reporting, and will also have the opportunity to invest into the activities which are environmentally sustainable under the taxonomy regulations. So they could use this opportunity for such investments. Moving on to the characteristics of a green bond under the draft standard. So in order for a bond to be called an EU green bond, it must fulfill certain conditions. First of all, there's no requirement that the bond is listed, so it can be unlisted. It does not necessarily need to be a bond. It can be any debt capital market instrument. The requirement it can be issued by either a European or an international issuer. So the requirement is not that it's focused on European issuers. The requirements are, though, that the issuer needs to have a green bond framework in place, which confirms its alignment with the European Green Bond Standard. Second requirement, most importantly, the use of proceeds of the green bond, they need to be exclusively used to finance or refinance new or existing green projects. Of course, if the value of a certain project is higher than the issuance of bonds, that's also fine. So it can finance a part of this project, but the entire proceeds of the bond itself must be used for this purpose. And finally, the alignment of the green bond framework with the green bond standard must be confirmed by an approved verifier. Maybe just coming back to what is the green bond framework, which must be made by the issuer. So this is sort of an internal document, an internal framework, which confirms its alignment with the European Green Bond Standards. and also provides certain key aspects and descriptions of the use of proceeds and the actual green projects which these bonds will finance. The green bond standard provides for certain reporting. First of all, there's the allocation reporting, and then there's an impact reporting. Allocation reporting is done on an annual basis until full allocation of the proceeds, or in case of any material change in the allocation. The impact report is done once in the bond lifetime, which reports on the environmental impact of the green project, which it finances with certain metrics, and generally also includes all the basic, all the important characteristics of the green project which is being financed. The green bond framework, as made by the issuer, needs to be confirmed by external verifier. Now, the green bond standards, the draft green bond standard provides for certain requirements of such a verifier. Eventually, it could be that this would be a regulated activity for which a license could be obtained, but currently the verifiers, the whole verifier structure moves more in the direction that this would be a certain voluntary registration system where the verifiers could register, fulfilling certain criteria. But eventually, if the draft gets adopted and if things develop, there would be a centralized system under the European regulative bodies. So when is the verification done? There's two verifications. One is done before or the time of the issuance to confirm the alignment of the framework, which provides for all the aspects of the green projects. And the second verification is after the full allocation of proceeds. It also verifies the actual allocation to green eligible projects in alignment with the actual allocation reporters. The verifications, there's also a disclosure requirement in this respect. The verifications will need to be made publicly available. Most commonly, or most likely, it would be sufficient if this is done through the websites of the issuer. When we come to the conclusion of all these new pillars, new regulations, the question, of course, immediately arises is, does this mean just an additional work for the investors or for the actual investees, or are there also any opportunities or any benefits in this respect? This is something that probably many of, especially investees and investors, would ask themselves once going through this somewhat vast new field of regulation, which is just in the process of being established. And I give the word to Neja.
Yeah, there should be some benefits, right? Maybe for the environment and for the society at large. So, and also for the investors, if we make everything more transparent and we use the same language while we are talking about certain risks, then we could reduce the cost for investors to identify and for corporates to fund environmentally sustainable activities. And last but not least, also increase environmentally sustainable activities and change the environment for the better. So we would live in cleaner, healthier, more climate-resistant living environment. So for sure there are potential benefits, but they come with additional costs, and these are as well as one-off and an ongoing cost for collecting, disclosing taxonomy relevant information and other things. Yeah, I think that the idea is to, in a way, stimulate expected raise to the top dynamic of the market, and to, by what the European Commission is trying to steer is this raise, this good good reputation and good practices that will, as you said at the beginning of this lecture, the research shows that the companies which are actually ECG compliant, or they take these factors in consideration, are also more successful currently. So maybe this good practice and expected raise to the top should help change the economy for the better.
Exactly, and I think what's also important to mention is that this framework, of course, is still in its development stage. Sort of, many of the aspects have not been regulated yet. It's developing day to day. I think it has been in much of public discussion of also how to incentivize both the companies and investors to take these considerations into account. There have been also discussions whether the taxation is to be further amended to stimulate such sustainable investments. This is done country by country, of course, and so what we're trying to say, of course, here is that we're at an exciting phase of this development. There have been many the most important regulations and acts are actually in the course of development. They have been enacted this year. Most of them, such as Green Bond Standard, is still in certain development, which probably the beginning of the next year will have more information on that. And maybe when it comes to Slovenia in the whole framework, as noted, most of the regulations are adopted at the EU level. When it comes to regulations, of course, the national legislation would most probably refer just to them directly, as they're directly applicable. When it comes to directives, national legislation would still need to be adopted in this respect. We did notice in our experience, in, let's say, public discussion, that while Slovenia and its participants, investors as well as companies, are progressive in certain aspects of sustainability and environmental preservation, they're still lacking behind in certain other aspects. So much work still needs to be done in this respect.
Yeah.
This concludes our presentation. I suggest we have 5 minutes break. In the meantime, if anyone has any questions, I suggest you put them in the chat box below. We come back after 5 minutes to review the questions, and then we can finally conclude. Thank you very much. Sorry, let me unmute myself. After this break, we received a couple of questions. We can address them now. If anyone has any questions, you can also put them in now. So the first question was, apart from possible carrots, what are the sticks which companies have to fear if they do not comply with green standards? As mentioned, if we talk about the green bonds as such, the green bond standards, there has been a vivid discussion whether the standards should be voluntary or obligatory. I think one possible stick when it comes to green bonds, of course, is the reputational risks. The general if the standards would become mandatory, then there's the general non-compliance with such. But if we talk about broader non-compliance with certain green standards or broader aspects of not addressing them, as mentioned, the key drivers were the actual consumers and the actual investors who also want to take these green aspects into their decisions in investment making and also in their consumer decisions. So when it comes to the bottom of it, it just means the loss of profit turnover, loss of markets. But as mentioned, of course, reputational risks are the ones which are having more and more emphasis on this.
Yeah, but additionally, also under taxation regulation, the competent authorities at the national levels will be competent to determine fines which are proportionate and are steering companies towards appropriate behavior. So there will be fines also applicable for taxonomy regulation and for disclosure regulation as well. They're not determined yet because it's on the national authorities to determine them, but we can expect some fines to be determined.
Yes, and I think second question we got is similar to that whether we expect that the vendors will demand from their suppliers to comply with sustainable practices. As mentioned, I think yes. Not only that certain vendors will have their own sustainable goals which they would need to fulfill themselves in order to be compliant, but there might have a broader expectation generally to work more towards fulfilling sustainable goals. So it comes from their sphere of them being regulated in a way and them fulfilling such criteria, as well as their general let's say policy to work with the suppliers or with the counterparties which do fulfill this criteria.
And maybe additionally, in the following years, additional taxation could also be the stick or carrot for companies to invest in sustainable practices. So it is possible that we'll have better taxation for European companies with suitable practices, or we would have additional costs put on Chinese and US companies who do not comply with these standards. But we will see how this will develop.
And then another question was, do you see a concern that European companies invest in sustainable practices for a higher cost, while powerful competitors from China and US do not comply to such costly standards? I think this has been in public discussion for a while now, and I think there is, of course, broader concern in this respect from public as well as regulator. And I believe what's clear benefit, or let's say clear direction in this respect, is to raise awareness among consumers of the positive effects in this respect, as well as generally incentivize and raise awareness among the other market participants of the positive effects of sustainable practices. I think this concludes our questions, which we received over the chat. If any of you has, there's another question. What about greenwashing? Is or should this be a concern in banking green bond market? Definitely. I think one of the main goals of the regulation is to prevent the greenwashing of such projects. So the actual goal of the taxonomy regulation is to clearly define what's an environmentally sustainable project, to prevent companies greenwashing them, because before the standards might have not been so clear, might have not been so detailed or so precise, and greenwashing was more likely, or it was more likely this to be abused. While by setting clear rules, clear framework, the risk of greenwashing is substantially reduced. And then we have another question. I'll just read it out. What is your advice to financial institutions on disclosure regulation, as the data on the underlying investments taxonomy is not yet available? And considering Neja was presenting disclosure regulation, maybe you can provide some insight into that, Neja.
Yeah, we can expect additional rules in this regard by the end of this year or in the beginning of next year. But for sure, if the data is lacking, this is an actual problem that market participants have been talking about ever since this discussion started. So what I have read is that the companies will actually have to know the companies that they're investing into, and in dialogue with them, get the best possible information they can. I do expect, as this is something that is an ongoing process and it's under development, that the regulators will have to provide additional guidelines, how to get the information, how to quantify them, how to arrange them, and so on. So it's a work in progress, and we will all see how things will develop.
And the next question was ESG taxonomy for government bonds, which are underlying investments in portfolios of financial institutions. What is your view on this topic, and how should we take this into account? Not really sure what is this targeted at, but maybe Neja, we can just discuss some broader regulation in this respect. I think we have a mute problem. Does
it work now?
Yes, it works.
Yeah, okay. If I I haven't seen the question in the chat, but if I understand it correctly,
I can repeat it for you. So, ESG taxonomy for government bonds, which are underlying investments in portfolios of financial institutions. What is your view on this topic, and how should we take this into account? Maybe we take first from your perspective of regulation, and then I can also speak from the perspective of the bonds.
Yeah, that's under the disclosure regulation. It will have to the portfolio manager will have to disclose. This part is now being marketed as environmental friendly, so additional disclosure regulation will apply. I think that in the next year, it's not from next year, but I think that from 2022, the portfolio managers or the institution will have to report on how these ECG objectives are achieved by these ECG bonds issued by the government. So, yeah, additional disclosure will be needed in this regard under disclosure regulation.
And when it comes to bonds, of course, note would need to be taken, as mentioned, whether such bond fulfills certain standards for these bonds to be green bond, either under the currently in use standards from the International Capital Markets Association or the new standards which should become applicable shortly, provided that the discussion ends in their favor, the effect of an European EU green bond. Maybe just to mention, I believe some of you sent the questions to the host, which we might have not received it. So if anyone has one of their questions unanswered, maybe you can just resend it in the chat box to everybody, or to just the presenters. Okay, so it seems that there's no more questions remaining. Thank you very much for your participation at the webinar. If you have any further questions or if you'd like to discuss any of the topics presented today or generally about the sustainable finance, we're more than happy to have a chat or to respond over the email in this respect. Thank you very much.
Thank you very much.